Welcome to ETF Leaders, powered by the New York Stock Exchange. I'm Judy Shaw. Joining me today is John Love. John is President and CEO of USCF. Thanks for joining me, John.
Thanks, Judy. Thanks for having me.
John, how do you expect global growth to impact commodities investing trends generally, and how do you expect China to affect the commodities markets?
Well, that's a great question right now. Both generally and with China, there is sort of a consensus that global growth is slowing. We know growth has slowed in China and is continuing to slow down. I would say that slowing global growth still equates to growth, and that still means that demand is rising. So it's rising at a slower pace, but still rising, so that's a good thing. I think in terms of China, the consensus, as I said, is that it will continue slowing. I wouldn't necessarily say that it's going to drop off. We don't know for sure. Nobody, the government has been very proactive in terms of managing their economy. So they could surprise us to the upside. We'll see. Other pockets, other sectors of the world are doing well. The U.S., as Chairman Powell said last week, is in a good place. Europe's a little mixed. Obviously, factory orders out of Germany last week were negative. You've got a mess with the Italian markets, the Brexit situation, but people are allocating money to Europe right now out of the U.S., even though the U.S. is demonstrably stronger. So I think there's still a robust market out there for commodities. One of the things that has weighed on commodities has been the trade wars, and if we get a resolution to that, then that could be a big boon for commodities. Another thing in regards to China is the fact that if the trade wars did go negative, what we might see is some dislocations for a while, but demand could pick up in other Asian markets as manufacturing moves to other areas. So in a way that would actually be healthier because you'd have a more broad market supporting the commodity space. So we'll see what happens there, but I think that's kind of what we're looking at with the global picture right now.
Do you see different impacts in different commodity sectors?
Yes, commodities are not homogeneous. Unlike equities, they do not move all together at the same time generally as equities do. Equities move together about 80% of the time. The average two commodities move together about 20% of the time. So different markets are definitely affected. You can have something like OPEC react to falling demand by lowering production and then reversing it, and that can be a healthy thing, but you can also have sugar producers flood the market at a time when demand is going down, which is something that's happening right now. So the different commodity markets can definitely experience different scenarios. There's no reason, the drivers for every commodity is different. There's no reason that crude oil and cocoa and cotton should all move together. And so that's something that we see generally, and that's actually one of the great things about commodities is you have this diverse opportunity set that allows you to take advantage of different opportunities. And if you have a smart system that can kind of pick the winners on average more often than the losers, then you have a market that's very interesting.
Now, how about investor sentiment? What is that like as it relates to commodities?
Sentiment has been somewhat negative. Everybody knows this decade has not been great for commodities. We've had some great bull markets in individual commodities. But we had gold peak in 2011, oil peaked in 2014, and we had in 2016 to early 2018, or actually the first half of 2018, a commodity recovery. A lot of people don't realize that, but commodities were doing very well. In the first half of 2018, we saw a lot of positive sentiment for commodities. What we got hit with last summer was trade wars. Then we had OPEC that was looking at the oil situation, say, hey, we're worried about an undersupplied market, so we're going to pump up production a little bit, and they ended up, because Iran sanction waivers were given out by the U.S., they ended up accidentally oversupplying the market and had to reverse course. But in the meantime, that of course took a toll on oil prices. So there have been all these starts and stops, and I know that that's difficult for people to digest and stick with. But the commodity story is never going to change. Commodities are economics 101. When demand drops off, generally suppliers react to that. It's just an asset class that we think that people should always be looking at. We don't know what's going to happen in 3 months or 6 months or a year, but we do know that the commodity story is not going to change. Commodities hold their value in inflationary periods, and especially when unexpected inflation hits. And they also are uncorrelated with stocks and bonds. So it's something that, although investor sentiment maybe down a little bit. This may be also the time to look at them, particularly as their returns have not been as robust as equities and bonds this decade. They're probably undervalued in that regard.
Okay, and what are some ways to invest in commodities?
Well, you can invest tactically, which is to look at individual commodities. A lot of people look at gold as an inflation hedge or a fear asset, but I would still say that that's a tactical play. Gold is not always going to appreciate. It goes through periods where it's stellar, and it goes through periods where it drops. It lost 40% after 2011. Same thing with crude oil. If you know that market and you understand the dynamics in that market, you can play crude oil, but you really do need to understand the specific factors. The other thing you can do, instead of using individual commodities or commodity ETFs, is play it strategically, and that's to invest in a broad commodity basket, which is actually a different value proposition, we think, than individual commodities. A broad commodity basket actually has a higher correlation to inflation than any single commodity, including gold. And it offers the diversification, as I said, the different opportunity sets that you get among uncorrelated assets, and something that's not correlated to stocks, not correlated to bonds, and has similar risk and returns to equities over the long term. So I would say depends on your needs. You can also combine strategic and tactical. You can invest in a broad commodity basket and at times overweight to energy or to metals or something like that using individual ETFs.
Great. Well, thank you, John.
Thank you very much.
And that's ETF Leaders brought to you by the New York Stock Exchange.